So today I'm going to be presenting material from Chapter 8 of this year's Green Budget, which looks at recent international attempts to tackle tax avoidance by multinational companies. Now, I'm sure you don't need me to tell you that the tax affairs of multinationals have been in the public spotlight in the last few years, and indeed in the last few weeks. And the concern has generally been that these companies have a lot of activity, but aren't paying very much tax in higher tax countries. Now, this public attention has filtered over into the political sphere. In the UK, there have been prominent interventions by the Public Accounts Committee, and more recently, the Treasury Select Committee. There have also been numerous UK corporate tax policies over the last 5 years, and they've sort of had two different flavours. On the one hand, the UK has been trying to become more competitive, slashing its corporate tax rate down to 20%. On the other hand, there have been a number of policies designed to close loopholes and prevent avoidance. And with the budget in March, the Chancellor will announce his business tax roadmap, which will lay out his plan for corporate tax policy in the rest of this Parliament. However, this is far from being just a UK issue. And in 2013, the OECD launched the Base Erosion and Profit Shifting, or BEPS project, which is a large multilateral attempt involving all of the largest countries in the world to try to rewrite the tax rules and update them for the 21st century. Now, this project reported in October, and the bulk of our chapter looks at these measures and assesses them. And of course, the government will have to respond to these in its business tax roadmap. Before we go on to talk about those specific issues, we have to ask the question, what problem are we dealing with, and how big is it? So the problem we're dealing with is tax avoidance. To find out what that was, I Googled it. Now, there are actually a few different definitions of tax avoidance out there. I've chosen this one from HMRC. And importantly, it defines tax avoidance as operating within the letter, but not the spirit of the law. And you can see the spirit of the law is an inherently subjective concept, and that's going to make defining avoidance quite difficult. Even if you have quite a clear idea of what you think avoidance is, it's still very hard to know the actual scale of avoidance. It's very hard to identify. As an example of this, the OECD in their recent project tried to estimate the worldwide cost of avoidance, and they came up with a huge range between 100 and 250 billion US dollars worldwide, and that's between 4 and 10% of global corporate tax revenues. So it's worth mentioning that while we undoubtedly do have a problem with avoidance, we haven't completely lost our ability to raise corporate taxes just yet. This chart shows corporate tax revenues as a proportion of GDP since 1979 for the UK and the OECD as a whole. And you'll notice that while the receipts tend to fluctuate with the economic cycle, there's no persistent downward trend here. Okay, so before we go on to look at those specific OECD measures, it's important to ask, how does our current system actually try to tax multinationals in the first place? So the problem of taxing multinationals is one of dividing profits between the different jurisdictions in which they operate for those profits to be taxed. Now, the current system doesn't try to tax profits based on the location of sales. Instead, it operates with the principle that profits should be taxed at source, that is, where the value is created. And I'm now going to run through an example to show how that operates in practice. So imagine a French pharmaceuticals company that wants to operate and sell in the UK. So what it's going to do is set up a subsidiary company in the UK to do its marketing and sales activity there. Effectively, what's going to happen is there's going to be a transfer of drugs from the French company to the UK company, and some profit, some income is going to arise from those sales in the UK. Now, we don't think that all of that profit should be taxed in the UK, because we know that a lot of the value-creating activity actually happened in France. So we're therefore going to require that the UK company make a payment to the French company for the transfer of the drugs. Now, these are called transfer prices, and transfer prices operate for all transactions within a multinational company across tax borders. And it's the main way in which profit is allocated between different countries. Now, of course, the big question for the allocation of profit here is, what's the correct value of that transfer price? And the international tax rules, they have an answer to this. They treat the two companies as if they were unrelated, and they ask the question, if these two companies weren't part of the same multinational group, but were in fact unrelated, how much would the UK company have to pay the French company for those drugs? This is the arm's length principle, and it operates in all transfer prices. Now, transfer prices don't just exist for the transfer of physical things. Say, for example, the French company had a trademark, a brand, and that the UK arm of that company used that trademark when it was selling in the UK. Effectively, that's a transfer of ideas from France to the UK, and there also has to be a corresponding transfer price there. So even though we may think about ideas and the transfer of physical goods as being very different things, the international tax system tries to treat them the same for the purpose of allocating profit. Now notice how if the arm's length principle is operating well, and these transfer prices really do reflect the correct arm's length price, that the international tax system is going to achieve what it's trying to achieve. Because if most of the value-creating activity happened in France, then that transfer price is going to be very large, and most of the profit will be taxed in France rather than the UK. However, in practice, there are some difficulties with this. Firstly, it can actually be very hard, conceptually and practically, to value transfer prices. Think particularly in that latter case when we're talking about the transfer of ideas. Ideas aren't generally traded between unrelated parties. Most of those transactions happen within multinational groups. That means that applying the arm's length principle, asking what would the price be between two unrelated parties, is really difficult. We just don't have any reference point for that. That creates uncertainty, and that means there's an opportunity for companies to try to manipulate those transfer prices to minimize their tax liability. Now, there's also another complication here, and that's that in a digital economy that increasingly relies on ideas are actually very mobile. So we may be worried that, say, the trademark were not managed in France, but were instead managed in some tax haven, that decision to manage the idea from there was really a tax-motivated decision rather than a genuine commercial decision. So let's just summarize what we've learned here. So note that this system, even when it's applied perfectly, can lead to large sales and low tax payments, and also to high reported profits in low tax jurisdictions. Observing these things in and of themselves is not evidence that avoidance is going on or that the system is broken. However, in practice, there are difficulties here. It's hard to value transfer prices. There's uncertainty there, and companies can exploit that. I've also, of course, just shown you a simplified version of the system there. In the real world that George Osborne and co are grappling with, there are many other complications as well. And difficulties often arise at the boundaries between tax systems, and companies can try to exploit that. So this is where the OECD came in 2013. They acknowledged that there were issues with the system, that it needed updating. So they didn't try to completely rewrite the rules and rip it all up. Instead, they tried to find the best way to patch up this system for the 21st century. So here it is, the OECD Base Erosion and Profit Shifting, or BEPS project. Base erosion refers to activities which lead to profit not being taxed anywhere, while profit shifting activity is activity which artificially moves profits from higher tax to lower tax countries. It was a large 2-year project involving all of the largest countries in the world. Now, importantly, the OECD can't force any individual country to change their domestic laws. So really, you could see this as a 2-year negotiation between the largest players in the international economy to try to build consensus on these issues. The project addressed 15 different action points, each of which looked at a different element of the tax rules. And when they reported in October, they came up with broadly one of 2 recommendations. All countries have agreed to implement and will be implemented in due course. One example of this is the transfer pricing rules that we talked about before. They're being amended to try to closer align profits with economic substance. However, a number of other changes are only recommended, so some countries will implement them, but others likely won't. And of course, in any project such as this, implementation is critically important. Now, this update isn't going to solve all of the problems we have with our system, but there are going to be some notable improvements. So, for example, all companies will have to file a country-by-country report detailing all of their substantive activities in each of the jurisdictions in which they operate. This country-by-country report will be shared between tax authorities, such as HMRC, and will help those authorities better target resources, such as audits, at those cases which pose the highest avoidance risk. Now, as we've already discussed, identifying avoidance is difficult, so this won't mean that all avoidance can be perfectly identified, but nonetheless, it's a welcome, transparent move. The international tax system has a definition for when a company has sufficient activity in a country for it to be considered to have a taxable presence there. There were concerns over the last few years that this definition had become outdated, particularly with the advent of the digital economy, and so the rules are being rewritten and that definition is being revised. It's now going to be harder for a company not to have a taxable presence in a country. I should note that it only moves the goalposts, so there's still an incentive for companies to try to cheat this and try to artificially avoid their taxable presence in a country, but nonetheless, it's another welcome move. Now, I said before that opportunities for tax avoidance arise at boundaries between tax systems. One example of this is when two different tax systems treat either companies or a specific transaction between companies differently. This is a large source of base erosion when profit isn't taxed anywhere, and these are generally called hybrid mismatches. From 2017, the UK is going to implement an anti-hybrid rule that was recommended in the BEPS process. Effectively, that rule is going to identify these cases that include UK firms and ensure that tax is paid anyway. It should be noted that while the UK is implementing this, not all countries are likely to, because it's only a recommended best practice and not a minimum standard that all countries have agreed to. And finally, the UK and a number of other countries have a patent box, which is a lower rate of corporate tax for income deriving from patents. Now, there were concerns that the way patent boxes were designed encouraged companies to shift income, the profits, but not the corresponding R&D activity associated with them. So the rules are being redefined, and the patent box is being modified such that the tax break has to be more closely linked to underlying R&D activity. I should note that this doesn't completely redeem the patent box. It remains a poorly targeted innovation policy. So these are four things that we know are going to happen. I'm now going to talk about what's probably the Chancellor's biggest decision with respect to BEPS when he comes to his business tax roadmap at the budget. So we've talked about a few different ways in which companies can avoid tax. They also have an incentive to locate lots of debt in higher tax countries to take advantage of the deduction from taxable profit that you get for the interest that you pay on those loans. And most countries, particularly larger countries, have some kind of rule restricting the amount of interest deductibility that a company is allowed. So the UK has recently consulted on a change, and we're expecting an announcement of the budget. And they're consulting on this change specifically, an OECD rule which would restrict the amount of interest deducted to a proportion of operating profit. Now, this is somewhat more stringent than the current UK provision, the worldwide debt cap, which is considered relatively lenient by international standards. Now, whether or not the UK implements this policy may well depend on how they balance a particular trade-off. And that's a trade-off that's actually present in a lot of anti-avoidance legislation, that because we can't perfectly identify avoidance, the rule, even though it would likely curb some avoidance, could also distort some genuine commercial activity that was never motivated by avoidance in the first place. This is particularly a concern with this rule for business models that just naturally include large amounts of debt, for example, the construction industry. However, there's also another trade-off here, and it's actually a bit of an elephant in the room of corporate tax. Countries actually face an incentive to compete with one another for corporate income and for corporate activity. So really, there's a second trade-off here between the UK's aim of preventing avoidance, but also maintaining its competitiveness. And this issue is particularly acute for the UK and interest deductibility because, as the government said in its corporate tax roadmap in 2010, the UK's current interest rules are considered by businesses as a competitive advantage. So here you see a very clear tension in the UK between its competitive aim and its desire to reduce avoidance. And it will be interesting to see how the Chancellor manages this trade-off when he makes his announcement in March. However, this is far from being restricted just to the UK. And really, in a way, this elephant has loomed over the whole BEPS process. You'll see this in the outcomes, that there are relatively few minimum standards that all countries have agreed to implement, and rather more recommendations for best practice that some countries will implement, but others likely won't. And this inability to reach consensus really reflects the fact that countries were unwilling to sacrifice their competitive advantage. Okay, so that was a bit of a whistle-stop tour of BEPS. Let me just clarify and summarise what I've shown you there. So the BEPS process is an impressive project, but it's not a silver bullet. Even though it will improve things in some cases, it's not going to put an end to opportunities for avoidance. Really, only time will tell how effective these measures are, and we should acknowledge always that countries do face this tension in corporate tax between reducing avoidance and trying to remain competitive. So a few more thoughts from me. Firstly, you may imagine that a drive to prevent avoidance would lead to a huge increase in UK revenues. Actually, the effect on UK revenues is relatively uncertain. Firstly, that's because we don't know exactly what policies the UK will implement or what effect those are likely to have. But also, we don't know what policies other countries will choose to implement, and they could also have an impact on the UK tax base. This isn't the last you're going to hear of coordinated international attempts to tackle avoidance. The European Commission recently introduced its own anti-avoidance plan, which in many cases tries to go above and beyond BEPS to try to achieve more coherence and agreement within the EU than was possible at the OECD level. However, they're likely to face the same problem, that countries are unwilling to sacrifice their competitive advantage. So a final thought. We should probably wait and see how effective these measures prove over the next few years. If we're still not satisfied, it could be that we want to consider more radical changes, for example, allocating profit based on the location of sales. However, we should acknowledge that any system has its own trade-offs and complications.